Back in early September, I did a video where I talked about how shorting the market after this massive plunge in late August was probably a bad idea. And the basic reason was because the market was extremely oversold after this move and needed time to digest that move. And what we've seen since then is essentially just that. We got a rally up into mid September off of that mini crash low, and then we fell back in late September, and then we've rallied again up to the top of this trading range, and it's kind of left to be seen here whether we can break out of here and start retesting all this overhead supply that was established all throughout the first half of 2015. Now, one of the key charts that I was looking at was the percentage of stocks in the S&P 500 above the 50-day moving average, and we can see back in late August that this number was extremely low. It was less than 10%, and this is generally a terrible time to start shorting stocks. You typically want to see, I've drawn this line here, but I want to see the percentage of stocks in the S&P 500 above the 50-day moving average close to 75% before I think it's going to be a good time to short the market. And we really haven't even seen that level all year, which is shows how weak this market has been. This is actually pretty rare. If you go back and look at past years, it's pretty rare to have the market barely above 75% for an entire year. So after this correction in August, I think we're going to see a kind of a rebound, rally on this thing, and we're going to go probably above this level is where I think would be ideal time to start shorting the market or think about shorting the market. And back in that video, I basically highlighted that the best time to short the market is when on the weekly price data when it's above the 30-week moving average. So, we're still, if you look at this next chart here, we're still below the 30-week moving average. But if we rally a little bit more in the S&P 500, we're going to get back above it. Or if we just continue to go sideways for a while, we're going to get back above this 30-week moving average. And notice that the slope of the 30-week moving average has gone from flattening out to now declining. So, we're starting to set up a downtrend here, but it's also possible that this correction just turns out to be a simple correction, which ignites another up leg in the markets. You'll have people on both sides telling you they know the future and predicting either a crash or another rally in this bull market, but it's best to let the price action determine the fate of the markets and just to go with what happens. So, but the best time to take a position on the short side would be as we go back into resistance and as we get above that 30-week moving average. Now, if you look at some of the leading stocks in the market, like for example, Facebook is holding up extremely well after that August plunge. It's really just consolidating and actually at a very high range. I mean, it's only a couple bucks off of a new all-time high. So you're seeing this kind of price action in a couple different leading stocks. If you look at like Amazon.com, for example, this thing's even acting stronger than Facebook. I would expect Facebook and Amazon.com to make new highs, even if the market rallies more from here, which I expect to happen. So, but if the market does break out into a new uptrend off of that correction, I would expect these stocks and some other stocks to be market leaders. Now, on the flip side, Biotech has been hit really hard in this correction, and now we're back below the 30-week moving average in Biotech, which is kind of unlike what happened in early 2014. We saw Biotech, pull back to the 30-week, but all it did was flatten out and kind of hold as support, which then launched another massive rally in biotech stocks. So this was actually an awesome entry point into biotech stocks. But here we've actually already pierced the 30-week moving average. Then we've retested it and failed again. So this price action is a lot more bearish than what happened in 2014, and I think it's going to be a lot harder for the biotech stocks to recover off of what's happened recently. More than likely, we're either setting up a new bear market in biotech or a long consolidation range, which is just going to eat away at people trying to play biotech from the long side. Now, over at my screening tool at screener.nextbigtrade.com, I'm going to start, monitoring what's going to happen in stock market sectors going forward. And what we're going to see is that, new leadership is going to form if the market does break out back to the upside into a new stage two. And we're going to start to see some of these sectors flip over into stage one and then stage two. If that doesn't happen, they're going to continue into stage four, and the rest of the sectors that are still holding up are going to fail. The same thing with the market indexes. We're already seeing a stage four across the board in the markets, which is not a good time to invest. But depending on what happens, this is either going to switch into a stage one, then into a stage two, or we're going to continue into a stage four. So we just got to continue to monitor developments in the market. And like I said, going back to this chart here, I'd like to see a little bit more of a rally from where we're at right now before the bear side looks right. But like I said, just pay attention to the charts and what happens